Hi everybody, it's Tom Sheridan and Chris Darbyshire from 7 Investment Management. We're here to talk about the Q3 asset allocation decisions that we've had to make, and boy have we had a time of it this time. Brexit seems like ages ago now, wasn't all that long ago, and we got a series of unexpected outcomes, Chris, didn't we? The vote itself, of course, was a major unexpected outcome. Going into it the night before, markets were up, looked like it was going to be Remain, and of course we now know that was not to be the case. On the back of that, we expected tumultuous markets, and equities did indeed go off, and steeply for a couple of days, but rebounded quite sharply. I mean, equities or FTSE is above where it started, I believe.
Yeah.
In the meantime, Cameron drops out of the picture. That was not so unexpected, but Boris also dropping out of the picture. That was unexpected. And Europe, there were a couple of things in Europe that we didn't fathom either.
Yes, we had the Spanish election on the Sunday after the referendum, so 2 days afterwards. And the fear was that a Brexit vote would encourage populist parties in Europe to want to leave the EU, and that could then fragment the Eurozone, and we're back into our Euro crisis again. Didn't happen though. The vote swung all the way back to the mainstream, really unexpectedly in Spain, suggesting that maybe Brexit is making people maybe think again and worry a bit more about the dangers of being outside Europe.
Do I really want to go through what those guys have just gone through?
Exactly. So this could be the opposite to what markets feared, and certainly I think some of the market rebound may be pricing in less fear of a Eurozone systemic crisis.
So just as if they were looking at the UK and saying, I don't want to go through that, huh?
That's right. I think the political carnage after the referendum actually scared people. We had polling in Finland. So Finland had been planning its own referendum, and there'd been polls taken to assess the appetite of the Finnish population for an in-out vote. And the polling fell from 45% wanting the referendum down to 31%
Wow.
a few days after the referendum. This seems to be a trend in Europe actually away from populism, which really helps markets.
So Chris, during this period of unexpected outcomes, you managed performance quite well. How did that come about when the anticipated outcome is not what we got, yet the portfolios held up?
Well, we felt very early on, really several months ago, that sterling was going to be the weak link leading up to the referendum. So we intentionally reduced our sterling exposure in favour of foreign currencies to try and stabilise the portfolios and preserve capital in the run-up. As we moved towards the referendum, yes, the polling and the betting began to look more like a Remain vote was likely. But we didn't feel confident in moving much beyond our strategic neutral position in sterling. So we moved back towards neutral, and there was enough foreign currency exposure on the day of the referendum then, when we got the big surprise and the collapse of sterling overnight preserved then the capital in the portfolios.
So the dollar became your insurance policy.
Exactly.
Right. So going forward, we still have more unanswered questions and possibly more unexpected outcomes. We need to form a conservative government, and we also need to figure out, although we voted for it, what Brexit is. So unbelievably, half the nation has voted for something which is as yet undefined.
That's very true. And the nature of the leadership of the Tory party will determine that question to some extent. But I think there are many different forms of Brexit. There's a Brexit light, what you might call a good Brexit, where we preserve access to the European Union, to the common market, and maybe get some kind of, opt-out on immigration policies.
Maybe.
Maybe, yeah. There's maybe a harsher Brexit where Europe really does try to play hardball and negotiate much harder with us. And then I think we'll find out what our negotiating power and position really is.
Right.
Of course, if we're in economic stress by that time, that would make our negotiating position that much worse.
I was just going to go there. I mean, you've given us the political side of the equation. What do we think we're looking at from an economic viewpoint?
Well, obviously great uncertainty. But I think the first indications are that there is a slowdown. Anecdotally, we're hearing this from businessmen. The property market almost certainly being hit, and of course the pound, having collapsed the way it has, will introduce inflation into the economy.
So that's a UK perspective, is it? So how about the rest of the world? How about, is it Europe and beyond Europe to the States and Asia? How wide does this issue go?
So I think a very bad economic outcome in the UK could be a bad but not terrible economic outcome in Europe. I think the rest of the world probably gets away with it, the reason being that the US economy is a bigger driver of the world economy than the European is. Yep. And the US economy actually seems to be on a reasonably firm footing at the moment and growing maybe slightly faster than people expected.
So we need to figure out whether we're looking at a UK event, a European event, a global event, or possibly even a non-event.
A non-event is a possibility. You know, it's possible that things could change so much between now and when Article 50 is triggered, which starts the exit negotiations, that people change their minds. And so a bit of economic turmoil could actually, and maybe a change in the political mood, could force people to rethink whether this was a good idea. Maybe we should have this vote again in some form, whether it be a referendum or a general election, once we know what Brexit actually might look like.
So if we're looking at a regional event, Brexit being something which is primarily going to impact the Europeans and the UK, from a portfolio positioning standpoint, maybe you could quickly recap where we've been, what we've just done recently, and what it is that we might do next.
We have decided to take some of our European stock market exposure and move that to the US, where I think things aren't cheap over there, but I think you've got a bit more economic momentum.
So in a balanced portfolio, order magnitude?
About 3% of our European exposure, 3.5% would go from Europe to the US. Then in fixed income terms, things are staying largely the same. We're not big fans of safe havens at the moment, although all the US government bonds that we bought have done an excellent job for us.
They did indeed.
We are going to keep the gold in the portfolio. That has been a good asset to hold in times of unexpected stress. And we're really, the decision we really need to focus on, the one we really need to monitor, and the one that's really going to be day by day is sterling. That's been our anchor in the portfolios. And when do we want to let ourselves drift a bit further from that?
So drift a bit further, meaning to hedge some of the dollars?
Yeah, so in other words, to take more, if we feel comfortable that sterling's reached a level which has priced in a lot of uncertainty, we might want to take a bit more sterling exposure and hedge foreign currencies. The key decision I think we have to make is if Brexit fears go away, then you might actually see sterling rebound back to its previous levels, which is something we need to control.
And how would Brexit go away?
Well, it's not out of question that things could change a lot between now and when Article 50 is triggered. So this is the event that triggers Brexit negotiations. A lot can happen between now and then. So we don't know when Article 50 will be triggered, and between now and then there could be some economic pain, there could be a lot of political uncertainty and political changes, and you might see the mood of the population begin to change from one of we want out to one of actually we want economic security back.
Right, that would be an interesting turn of events if that's the way it transpires.
Certainly would.
Okay, and I know you've held some cash in the portfolios to take advantage of opportunities as they might arise. In a balanced portfolio, where are we in terms of cash levels?
We're about 10%, so still pretty high by our standards. But it plays a role at the moment. It gives us some dry powder in case there are opportunities that arise, and it's one of our preferred stabilisers at the moment.
Okay, so if I could summarize the portfolio positioning then, and please correct me if I haven't got it right, about neutral position in equities, but we've regionally made a shift from Europe to the States to account for the uncertainties that we have in the region. From a fixed income perspective, not wildly different from where we've been, perhaps a bit of emerging market bonds in addition. You've held on to the gold, you've held on to the cash, so we have something to take advantage of opportunities. So a reasonably cautious approach to a still uncertain world that we're looking at, and you've got currencies as your lever to handle the risk on, risk off without doing major things to the asset classes.
Yes.
Is that a fair summary?
I think it is. I mean, it's a bit of a holding pattern until the Conservative leadership is decided. So I think we're happy just avoiding Europe and the UK for a while, maintaining our overweight to emerging markets, mainly emerging Asia and also to the US, but monitor that sterling exposure very carefully indeed.
So what we probably ought to do then is to tell the listeners that as and when that moment in time comes, that although we usually do this every 3 months, we may come back sooner than 3 months if we start adjusting the portfolios in response to those events as they unfold. Fair enough?
Yes, I think so.
Okay. Well, Chris, you've done a wonderful job during the period of Brexit. Thank you very much for yours and the team's efforts, particularly the night that you spent camped out here for 24 hours. And we'd like our listeners to know that we're doing everything that we can to make a reasonable return within the confines of preserving capital during these very, very awkward times. Chris, thank you.
Thank you.